Return on equity, or ROE, is a key measure of a company's profitability. It tells you how much profit a company generates for every dollar of shareholder investment. Think of it like this. ROE is the juice you get from squeezing the shareholder's equity lemon. A higher ROE generally means the company is using shareholder money more effectively. Investors love a high ROE because it means their money is working hard for them. A strong ROE can indicate a well-managed, profitable business. Companies with consistently high ROEs often attract more investors, boosting their stock prices. On the other hand, a low ROE could be a red flag. It might signal that the company is struggling to generate profits or is not using its resources efficiently. Before hitting the panic button, it's important to compare a company's ROE to its industry peers. Remember, ROE is just one piece of the puzzle when evaluating a company's financial health. But it's a powerful indicator that can give you valuable insights into a company's performance and potential. So, keep an eye on ROE and you'll be on your way to making smarter investment decisions. Calculating ROE is simpler than you might think. It's just net income divided by shareholder equity. Net income is the company's profit after all expenses are paid. Shareholder equity represents the value of the company owned by its shareholders. Let's say a company has a net income of $100 million and shareholder equity of $500 million. Its ROE would be 20%. This means the company generated a 20% return for its shareholders. But what does that 20% really tell us? It's important to compare a company's ROE to its past performance and its competitors. An increasing ROE over time suggests the company is becoming more profitable. Similarly, a higher ROE compared to industry peers indicates a competitive advantage. However, don't rely on ROE alone. A company might have a high ROE due to factors like taking on a lot of debt, which can be risky. It's crucial to analyze other financial ratios and factors to get a complete picture of a company's financial health. Financial leverage or using debt to finance operations can be a double-edged sword for ROE. Think of it like this. Debt is like steroids for your investment returns. It can amplify gains but also magnify losses. Here's how leverage works. When a company uses debt to finance its operations, it only needs to earn a return on that borrowed money that's higher than the interest expense to boost ROE. This is because the company is essentially using someone else's money to make money for its shareholders. However, excessive debt can be risky. High debt levels mean higher interest payments, which can eat into profits and make the company vulnerable during economic downturns. If a company can't meet its debt obligations, it could even face bankruptcy. The key is finding a balance. Moderate levels of debt can be beneficial, allowing companies to invest in growth opportunities and enhance returns for shareholders. But too much debt can be a recipe for disaster. ROE is a powerful metric for evaluating a company's profitability and efficiency in utilizing shareholder investments. By comparing a company's ROE to its historical performance and industry peers, investors can gain valuable insights into its financial health. However, like any single financial ratio, ROE should not be used in isolation. It's crucial to consider other factors such as debt levels, industry dynamics, and overall market conditions. Remember, a high ROE doesn't always tell the whole story. Moreover, be aware that ROE can be manipulated through accounting practices like aggressive revenue recognition or share buybacks. Always conduct thorough research, analyze multiple financial ratios, and consider qualitative factors before making investment decisions. In conclusion, while ROE is a valuable tool for assessing investment opportunities, it's essential to use it wisely and in conjunction with other analytical tools. By doing so, you can make more informed investment decisions and potentially boost your returns.